Imagine you built a company from nothing, and it actually worked. You have customers now, revenue, maybe even a warehouse full of product moving out the door faster than you can restock it. There is just one problem. Growing further needs money, and you have already spent your own. So what do? You could ask a bank for a loan. You could find one wealthy investor. Or you could do something much stranger. You could sell tiny pieces of your company to total strangers all over the world, all at once. That is what going public actually is. This idea is older than you probably think. In 1602, the Dutch East India Company needed an enormous amount of money to fund risky, expensive voyages to Asia. Instead of borrowing it, the company sold shares of ownership directly to the public in Amsterdam. Anyone could buy in. Anyone could later sell their shares to someone else at whatever price a buyer was willing to pay. This was, by most historians' accounts, the first modern stock in the first modern stock exchange, and the logic behind it has barely changed in over 400 years. Here is the mechanism, stripped down to its simplest form. A private company is owned by a small number of people, founders, early employees, a handful of investors who took a risk early on. Going public through what is called an initial public offering, or IPO, means the company divides its ownership into millions of individual shares and sells a portion of those shares to the general public for the first time. In exchange for giving up part of their ownership, the company receives a large amount of cash, all at once, to spend on growth. But why go through all this trouble instead of simply taking out a loan? A loan has to be paid back, with interest, on a schedule. Whether the company is thriving or struggling, selling shares is different. The company owes the new shareholders no fixed repayment at all. Shareholders are betting that the company will become more valuable over time, and that their slice of ownership will be worth more later than what they pay today. If the company fails, the shareholders lose their investment. The company itself owes them nothing back. This is precisely why an IPO looks so appealing to founders. It is growth capital that does not have to be repaid on a fixed schedule. Going public is not simple, though. A company preparing to list must open its finances to outside auditors, publish detailed reports on its performance, and follow strict rules about what it is allowed to say publicly about its own future. Large financial institutions, known as underwriters, help decide an opening price for the shares, based on demand from big investors during what is called a roadshow. This is a period where company executives travel to pitch the business directly to major funds before the shares ever reach public markets. On the day the shares finally begin trading, one particular number gets an outsized amount of attention. The difference between the price the company sold its shares for and the price those shares trade at once the public gets involved. When that price jumps sharply higher on day one, headlines call it a wildly successful debut. When it does not, headlines call it a disappointment, even if the company itself raised exactly the money it needed. Going public also changes who a company answers to. A private company answers mainly to its founders and a small circle of investors. A public company answers to every shareholder who owns even a single share, and to financial regulators who now oversee what it discloses and when. That is the real trade at the heart of every IPO. A company gains a vast new pool of capital to grow with. In exchange, it gives up a measure of its own privacy and a measure of its own control. There is a reason so many founders describe the day of their IPO in oddly emotional terms, ringing a ceremonial bell at an exchange, surrounded by employees who joined years before anyone else believed in the idea. That ceremony marks the exact moment a private dream, owned by a small handful of people, becomes something millions of strangers can own a tiny piece of, sight unseen, based only on public documents and a shared bet on the future. It also explains why some founders choose never to do this at all, preferring to stay private indefinitely, raising money only from a small number of chosen investors, precisely so they never have to answer to a stock price moving minute by minute, or a stranger on the other side of the world who has never set foot in their office. 400 years after Amsterdam, the deal has not changed at all. Now you know.